Welcome to my channel. I'm Scott, and in this video, I am going to walk you through the process of valuing Dollar Tree stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Dollar Tree is a chain of discount stores that sells items for $1 or less. It operates 15,685 stores throughout the 48 contiguous US states and also in Canada. Contiguous means sharing a common border or touching. So if you hear 48 contiguous US states, that just means it's excluding Alaska and Hawaii. Its stores are supported by a nationwide logistics network of 24 distribution centers. Each store stocks a variety of products, including national, regional, and private label brands. The departments in the store include health and beauty, food and snacks, party, seasonal decor, housewares, glassware, dinnerware, household cleaning supplies, candy, toys, gifts, stationery, craft supplies, teaching supplies, automotive, electronics, pet supplies, and books. Most of the stores also sell frozen food and dairy items such as milk, eggs, pizza, ice cream, frozen dinners, and pre-made baked goods. It was originally called only $1 from 86 to 93. It is able to charge only $1 because it works extremely hard to find the best bargains, and it has significant buying power since it can purchase a lot of products at a time. It has 227 stores in Canada, but the prices are 1.25 Canadian dollars or less, since 1.25 Canadian dollars equals $1 US. The company is headquartered in Chesapeake, Virginia, and was founded in 1986. It started trading in 95 and can be found on the Nasdaq, Mexican Bolsa, Deutsche Borse, London Stock Exchange, Vienna, and Sao Paulo Stock Exchange. Let's get started with the model. This is a large cap company, 21 billion market cap. They're trading at $93 a share, and they have 225 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they do have a lot of free cash flow left over each year. 800 million was the lowest and 1.8 billion was the highest. You want to invest in a company that has positive free cash flow because that's the money that's left over for you, the investor. If a company has negative free cash flow, there's nothing left over for you. A company can use their free cash flow to pay you a dividend, to buy back stock, or to invest back into their business to make it bigger. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that was negative in 2018, positive after that. Revenue is the sales for the company, and that goes up each year. It's doing the best during COVID. It's close to $26 billion of revenue. This is the company's income statement. The top line is the revenue, the sales. So about half their revenue comes from their Dollar Tree stores, and the other half from Family Dollar. They acquired Family Dollar in 2015 for $8.5 billion. The largest dollar store in the US is Dollar General at close to 17,000 stores. Even if you combine Family Dollar and Dollar Tree, that's lower than Dollar General. Below revenue is the cost of revenue. Some items in cost of revenue are the cost of the merchandise, also warehousing and distribution costs. Revenue minus cost of revenue gives you your gross profit, and that grew from 6.9 billion to 7.9 billion. Below that is operating expenses. And their operating expenses are selling, general, and administrative expenses. Those are advertising, payroll, and rent. And below that is operating income, and that peaked in the trailing 12 months at 2.1 billion. They spent 138 million of interest on their debt, and the bottom line of the income statement is their net income. And that was 1.5 billion in the trailing 12 months. It was negative 1.6 billion in 2019. When Dollar Tree acquired Family Dollar, they paid a premium for the company. The premium Dollar Tree paid when they acquired Dollar General goes in the goodwill. Goodwill is an intangible asset. Each year, a company has to test for goodwill impairment. So in 2019, Dollar Tree felt the value of Dollar General should be $2.7 billion less. So they reduced goodwill on the balance sheet $2.7 billion and passed through a loss onto the income statement. This has nothing to do with cash flow. The cash happened in 2015 when they acquired the company. These are just accounting items. So when someone looks at the income statement, they may feel they lost $1.6 billion of cash in 2019. That's a $1.6 billion accounting loss. I'll show you in a statement of cash flows. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So they actually generated $1.8 billion from running their business in 2019. So you could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So you can see they generate a sufficient amount of cash flow each year. This is after paying all the expenses from running their day-to-day operations. They do have a good amount of CapEx each year because every time they open a store, the amount they spend in the infrastructure to build out that store goes into CapEx. Operating cash flow minus CapEx gives you your free cash flow, and they do have a good amount of free cash flow remaining each year. So they are paying down debt. They issued $4.8 billion in 2019. They paid down $6.3 billion. So they paid down about $1.5 billion of debt in 2019. They paid down $500 million in 2020. They paid down $550 million in 2021. And they paid down $800 million in the trailing 12 months. So that's a good use of cash flow to pay down debt. That reduces the interest payments they pay in a debt, which means it's more money to go into your pocket or to invest back into the business to grow it. They don't pay a dividend, but another way to reward shareholders is to buy back stock. They bought back $200 million in 2020, $400 million in 2021, and $1.3 billion in the trailing 12 months. When a company buys back stock, that decreases the shares outstanding, making your shares more valuable. This is the equity section of their balance sheet. They have $7 billion of equity. They raised $1.2 billion from issuing stock, and they took that $1.2 billion and generated a business with $5.8 billion of profit. So that's a 5x return on the amount of money they got from their investors. So they're doing a good job at running their business. Let's look at the capital structure. $7 billion of equity, $10 billion of debt. They're 42% equity, 58% debt. Their weighted average cost of capital is 7.6%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $31 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $28 billion. We divide that by 225 million shares, and we get a calculated stock price of $124. They're trading at 93, so they're trading at a 25% discount. It's a buy according to the model. The analyst forecast is for this company to grow their revenue 5.5%. I grew their revenue 5.5% each year until 2025. That's how I calculated their future revenue. To calculate their future free cash flow, first I needed to see how much of their revenue they convert to free cash flow. So I summed up these 4 free cash flow amounts. I divided by the sum of these 4 revenue amounts. That's about 5%. So they convert about 5% of their revenue into free cash flow. So I multiplied each revenue number by 5%, and that's how I got the future free cash flow numbers. So the stock seems like a great value at $93. Simply Wall Street values the company at $129. They're saying it's 28% undervalued. 12 analysts priced this stock, and the average price target was $106. Here's the stock price since 1995. So you can see it's pretty much gone up overall. There were some big dips here and there, but overall the stock price has gone up. Here's a candlestick chart the last 12 months. The stock price today is pretty similar to the stock price 12 months ago. So when you see a green candlestick, that means on that particular day, the closing price was higher than the opening price. If you see a red candlestick, that means on that particular day, the closing price was below the opening price. If you own the stock, you probably want to see more green candlesticks than red ones. And you can see these gaps. That's during earnings. There's a lot of pre-market and post-market activity. So the closing price on one day is really different from the opening price on the next day. They usually connected the candlesticks, but sometimes during earnings, or there could be gaps when there's a lot of breaking news on a company. So you can see the stock price was driven up to over $120 a share. And then it came all the way back down to $91 a share. So it seems like 120 may be the resistance point and 90 may be the low resistance point. So this seems like a good opportunity to get into the stock. And if it runs back up to 110, 115, you may want to sell it because it may come back down. But I usually invest for long-term holds. But I know some people are swing traders or day traders, and they try to follow these charts. They have a pretty low beta, 0.84, so the stock is less volatile than S&P 500. The stock is flat over the past 52 weeks, while the S&P is up 33%. The 52-week low was 84, the high was 120, and the stock is trading below its 50-day and 200-day moving average. About 3 to 4 million shares are traded each day on this stock. Of the 225 million shares outstanding, 222 million are on float. 93% are held by institutions, so it has a pretty high institutional ownership, and 3% of the shares on float are shorted. Here's a list of the short interest the past 12 months. The lowest was back in November of last year at 2.3 million shares shorted. It peaked about 3 months ago at 6.2 million shares shorted. The stock price was a lot higher 3 months ago, and I guess as the stock price comes down, the short interest comes down. Although the short interest is up the past month, it was 4.4 million on 7/15. On 8/13, it's 5.5 million. This stock hasn't performed that well past year, 3 years, and 5 years. It is up, but it's not doing as well as its industry and the market. Analysts seem bullish on this stock, projecting their earnings to grow more than their industry and their revenue to grow more than their industry. In the past 5 years, their annual earnings decreased 6%, but in the past year, it's up 82%. If you put $10,000 into this company 10 years ago, you'd have $26,000 today. That's a 10% annual return. So that's about the annual return of the S&P 500. And they have a lot of institutional ownership. Vanguard owns 10.5%, then BlackRock 8.5%, State Street, T. Rowe Price, and the Australian investment bank Macquarie. They have really solid price multiples. Their PE is 14. That's much better than the market median and average. PE is stock price over earnings per share. Or you can take the market cap over net income. Price to sales is amazing. It's below 1 at 0.8. That's stock price over sales per share. Or you can take market cap over revenue. And price to book is also really good at 3.0. That's stock price over book value per share. Or you could take market cap over equity. They do have a lot of intangibles on their balance sheet, $5.1 billion. They have a good return on invested capital of 10%. They can cover their interest payments 15 times. A really high ROE at 21%. And they have a good current ratio at 1.2, but a low quick ratio of 0.3, because quick ratio strips out the inventory from current assets. And they're mostly inventory. They're always sitting on a lot of inventory. They probably turn it over pretty quickly, but at any point in time, they have a ton of inventory. And they're well capitalized. They generated $1.1 billion of free cash flow in the trailing 12 months. They have $900 million of working capital, so they have over $2 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos on Big Lots, Costco, Dollar General, Dollarama, Magnet, and Walmart, all in the same industry as Dollar Tree. And if Dollar Tree has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. I also highlighted Dollar General's numbers because they're a pretty similar company. So you can see Dollar Tree has great price multiples, much better than the average. They have a good current ratio, a high ROE, they're a little lower in debt than the average. They're a lot lower in market cap because Costco and Walmart are in this industry, and they don't pay a dividend. Price multiples are a great way to compare companies, because you can't look at a company's revenue, because if that was the case, Walmart is a million times better than these companies. But maybe Walmart is overvalued. You have to look at revenue relative to market cap, or earnings relative to market cap. That's how you equalize companies, at least in the same industry. So you can see Dollar Tree is a better value than pretty much all these companies. Definitely better than Dollar General. And the reason it's such a good value is because their market cap is so much lower than Dollar General. So they do bring in less revenue than Dollar General, but as a percent of their market cap, they bring in more revenue. So to summarize, I have them trading at a 25% discount. The great thing about their business model is there's always going to be people below the poverty line that need to go to their stores. And there's plenty of people in the middle class or upper class that go to their stores as well, because everybody's looking for a bargain. I don't care if you make $10,000 a year, $100,000 a year, or $1 million a year. We all like a bargain. So there's definitely demand for their products as long as the company can continue executing and building out stores and giving good customer service, they'll be successful. And so far, they've done that pretty well. I ranked their free cash flow 6 out of 10, their revenue 8 out of 10, and their ratio is 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.